Welcome, everyone. Another great video for you today. As you can see, this is not Kevin Becker. Kevin's on vacation. We brought in Scott Chan, who's an analyst. He's actually the managing director of equity research for the financials here at Canaccord. Been in that position for 13 years. He's going to help us out talking about banking, talk about the U.S. banking crisis, the Canadian banks. Scott, why don't we just dive right in? I'll throw this up because I know many clients, many folks, we heard all the headlines, SVB, what's happening with First Republic. Why don't you bring us up to speed on what's happening with the U.S. regional banks?
Yeah, thanks for having me on, Clinton. The U.S. regional banks, it's still a very fluid situation, and I think we're still in the early innings on what we are going to see going forward. At the start, you mentioned what everyone has seen: the Silicon Valley Bank fail, the Signature Bank, First Republic, and then Credit Suisse. And then we kind of look at the Q1 results that the U.S. mega banks and regional banks had. We certainly saw a lot of these headwinds a little bit and what we should expect going forward for the next few quarters. There's two primary issues when you look at the balance sheet, Clinton. One is
Okay.
assets and one is on the liability side. And what these regional banks that failed got in trouble with was on the liability side in terms of deposit runoffs. And to tell you the truth, at least right now, it looks like it's very concentrated in the West in the US in terms of failures. We have seen some contagion into the US Midwest and into the US Southeast in terms of deposit runoffs, but not to the certain extent on the fears that we're seeing out West. And we saw that play out in the quarter. What people are looking at right now is really studying on the asset side of the balance sheet. So the loans and the securities that they own. Um, and because the Fed raised interest rates so highly since the start of 2022, and it's probably going to continue throughout 2023, just based on the forward curve, a lot of these securities that were held to maturity, would be forced on sale based on the runoff deposits to match the assets and liabilities, and that's
Yeah.
where these banks are getting into trouble. And of course, when interest rates go higher, the price of bonds, mortgage-backed securities, U.S. Treasuries go lower, and we've seen some mismatches and losses that have really impacted the equity value or the tangible equity value on the banks that failed and several other U.S. regional banks that we track right now. I would say the regulators are, been a bit slow, but earlier this week they did announce some higher capital requirements for the larger U.S. banks that have over 100 billion of assets. I think when Trump was in administration, that level was much higher at over 250 billion. So Silicon Valley was a bit below that. So what you're going to see going forward is going to be more stringent regulatory standards on the U.S. side. And then what I think we'll see once this stabilizes, which I think we're several quarters away, is going to be a significant U.S. M&A consolidation cycle in the U.S. marketplace.
Okay, I appreciate that. Two quick follow-ups there as you were chatting. One was the regulatory piece, because there's different regulations, as you mentioned, depending on the level of institution in the U.S., like big U.S. banks versus mid-tier versus small, for example. And you mentioned the threshold there is coming down, so these heftier regulations will apply to more U.S. banks. Is that the case?
That is the case.
Okay.
Yeah, so like before, the larger US banks really didn't have to abide by a lot of the capital and liquidity measures that the Canadian banks here in Canada abide by because they are systematically important here in Canada and they are an oligopoly. So we would expect a lot more stringent regulations to kind of prevent this deposit runoff and the scenarios that we kind of talked about on the asset side to happen again.
Okay. And you kind of already touched on what I had as the second point there, which is leading into the Canadian situation, right? Canada, we have not seen anywhere near the level of instability that the U.S. went through, but we did just have the Canadian banks report their earnings, and there was a bit of a market reaction there, right? A couple of surprises. So why don't you give us a quick update on the Canadian side of the equation here?
Yeah, the Canadian banks in terms of domestic exposure is really resilient from the U.S. regional banking crisis. What we are seeing impacting fiscal Q2 results and the near-term outlook is the Canadian banks that have U.S. exposure. So you think about TD having the highest U.S. exposure. BMO second, Royal and CIBC have little US PNC exposure, and Bank of Nova Scotia, National Bank don't have any. And you started to see through, the results in terms of some of the headwinds that we talked about, deposit runoffs, much slower loan growth, contraction of NIM, higher credit normalization. Another asset piece that I didn't mention before is commercial real estate. So there's been a lot of talk about U.S. office space and that sector getting marked down, and select Canadian banks, including CIBC this quarter, provisioning much higher for that segment. So
Hmm.
soft fiscal Q2 results. Most of the banks missed headline earnings. And then from a street perspective, we saw fiscal 2023 and 2024 EPS revisions being revised down 2% each in both years. So the one bright spot I will say, and it kind of goes back to the US regional banking crisis, is that the Canadian banks built up a lot more excess capital than the street expected in fiscal Q2. I would say 2 times the amount. And that's very important in this marketplace as well. And then we look at liquidity ratios as well. The banks are cognizant to build up liquidity much higher than the minimum regulatory
Hmm.
requirements. So, although the kind of the base business and operational performance was a bit weak, from a capital and liquidity standpoint, the banks look pretty good. And as we expected, 5 of the 6 Canadian banks did raise their dividend in the quarter. The group offers a very attractive yield of over 5% right now for investors.
Okay. And just to highlight there some of the differences, because we do get lots of questions from folks. Understandably, the last few months have been a lot of headlines when it comes to banking with all the failures we've seen in the US, is that the capital structure, so kind of all the money they have on hand to avoid a banking issue like you had with Silicon Valley or with First Republic, you're saying for the Canadian banks is quite strong. And in the recent quarter is more just kind of base business issues, kind of a rough quarter versus any kind of underlying concern with the Canadian banks.
Yeah, absolutely. So when you think about the deposits that were the issue in the US marketplace, when you look at
Hmm.
Canada and fiscal Q2 results, deposits were actually up modestly quarter over quarter
Okay.
in Canada. But when you look at the US exposure that the Canadian banks have, they were down quarter over quarter, kind of in line
Hmm.
with the big US large regional banks that we track. Specifically, TD was down more, and I think it disproportionately impacted their stock price in the quarter as well.
Okay. Well, I certainly appreciate that. We'll have one more question for you before we do. A quick reminder to folks, if you have questions for us, whether it's specifically on investments, like we're talking here about the bank stocks, or in any other financial planning item, we'd love to hear from you. Simply go to the site at the bottom of your screen there, chatwithclintonkevin.com. Fill in the form, comes right to us. We'll get back to you as fast as we can. We certainly appreciate the feedback and we'd love to hear from you. Last question for you here, and I have to make you be a bit of a forecaster if you can look forward. Talking about the Canadian banks, you mentioned a rough quarter. Where do you think they're going in the next 10 to 12 months? What's the forecast?
Yeah, like from a stock perspective, we're pretty constructive. We're pretty constructive on the market. A lot of it is a macro call, and we are seeing some good green shoots on a better macro environment in terms of
Mhm.
lower inflation. Employment remains very, very strong. I believe we're heading into a soft landing or a mini recession, and that would be good for Canadian bank stocks if that scenario happened, just based on where they trade today from a valuation perspective. I do think fiscal Q3, as we enter a very seasonally slow quarter, specifically in capital markets, results could be a bit soft. The one other
Mhm.
piece I didn't mention before was expenses. Year to date, the Canadian Big Six banks' expenses have increased 13% year over year. And that's just like
Okay.
unusual, and unusual in a sense from Royal Bank, which is the largest bank. Expenses were up 17% year over year. So a lot of the management teams have kind of talked about um, better expense control. It may not happen next quarter, but if we look into fiscal Q4 in 2024, I think better expense control can help support that EPS number from the banks as well. So we're incrementally positive. I think the short term, we're a bit cautious, but the macro environment seems to be getting a little bit better. I think we are in for a soft landing or mild recession,
Mhm.
and I think the Canadian bank stocks can rally towards year end and into next year.
Okay. So with a more constructive macroeconomic view, it'd be better for the Canadian banks. And then you mentioned you believe they could get a bit of expense control, which can help the earnings per share as well. So it's a bit of more good news, I would say. A little bit of an optimistic view, cautiously optimistic on the Canadian banks.
That's right.
All right. Well, we certainly appreciate you giving us some time today. We'll be back again soon, folks, with another video. So we'll leave it there for right now. Take care.